Well, let me tell you something. When a man sits on $381.7 billion in cash and refuses to buy his own stock for 5 straight quarters, you should probably pay attention. This isn't some young hotshot trying to make a name for himself. This is me, 95 years old, been doing this since 1951, and I have seen every kind of market you can imagine. Now, people ask me all the time, Warren, why are you holding so much cash? And the answer is pretty simple, you see. I can't find anything worth buying. That's it. That's the whole story. When you've been around as long as I have, you learn something about prices. And right now, prices don't make sense. Berkshire Hathaway, the company I built over 70 years, just reported its 12th consecutive quarter as a net seller of stocks. 12 quarters. That's 3 years. We're not buying, we're selling. And we're piling up cash at a pace I've never seen in my entire career. You know, our cash position is now 31% of our entire portfolio. Think about that. Nearly a third of everything we own is sitting in treasury bills earning 4% or so. Now, some people say, Warren, you're missing out. The S&P 500 is up. The market's hitting new highs. You're underperforming. And they're right. Berkshire stock is down 2% since I announced in May that I'd be stepping down at year's end. We're trailing the S&P by 12 percentage points this year. Greg Abel, a good man and a smart operator, he's taking over in less than 2 months. And I'm leaving him with the biggest cash pile in Berkshire's history. But here's what those critics don't understand, you see. I'm not trying to beat the market this quarter or next quarter. I'm trying to survive the next 50 years. And survival means having cash when everyone else is begging for it. Let me tell you what this reminds me of. Back in 2007, we were sitting on a big cash position, and people said the same thing. Warren, you're too cautious. You're missing the party. Then 2008 happened. Lehman Brothers collapsed. The credit markets froze. And you know what? We had the cash to buy. We bought Goldman Sachs. We bought General Electric. We made deals nobody else could make because we had the capital and the credibility. This feels like that, only bigger. Now, I don't have a crystal ball. You understand? I can't tell you when the market's going to turn, but I can tell you that when you're paying 28 times earnings for the S&P 500, and when 10 companies account for most of the index's gains, and when the government is running deficits we haven't seen outside of wartime, well, that's not an environment where I want to be aggressive. Kathy Seifert, analyst over at CFRA Research, she said something smart the other day. She said, Berkshire is supposed to be a proxy for the U.S. economy, but right now we're not even keeping up. And she's right. Our revenue growth in the third quarter was 2%. That's below GDP growth. Our subsidiaries, Clayton Homes, Duracell, Fruit of the Loom, they're all feeling the consumer slowdown. You see, when people are worried, they don't buy houses, they don't remodel, they don't spend on things they don't need. And that's what we're seeing across our businesses. The consumer is tapped out. Confidence is shaky. And that shows up in our earnings, even though our operating profit was up 34% in the third quarter to $13.49 billion. But here's the thing. That profit number, it's a little misleading, you know. Over 2/5 of that gain came from currency fluctuations. Geico's doing okay, growing policies, but acquisition costs are going up. BNSF Railroad, our freight business, profit rose 6%, but that's mostly because fuel costs went down and we got more productive. Berkshire Hathaway Energy, that was down 9% because of wildfire, legal bills, and pipeline expenses. So yeah, we made money, but it wasn't easy, and the headwinds are real. Now, I've always said, be fearful when others are greedy, and be greedy when others are fearful. Right now, people are greedy. They're chasing stocks they don't understand at prices that don't make sense. And I'm fearful, not fearful like panic, fearful like cautious. Like I know this movie, and I've seen how it ends. James Shanahan, analyst at Edward Jones, he just upgraded Berkshire to a buy. And he said something I agree with. He said, if you feel like stocks are expensive, including your own shares, you're eventually going to be right, but you can be wrong for a long time, and that's true. I've been sitting on cash for 3 years now, and the market kept going up. But I'd rather be early than sorry. Tom Russo, one of our longtime investors, he gets it. He said, Berkshire isn't going to deploy capital that won't increase intrinsic value. And that's exactly right. I'm not in the business of buying stocks just to be in the market. I'm in the business of buying value. And right now, there isn't any. So this cash pile, it's not a mistake. It's a signal. It's me telling you that I think we're in the late innings of this bull market, and I want to be ready when the reset comes, because it always comes. It always does. You know, before we go any further, I think it's worth explaining why anyone should listen to me in the first place. I mean, there are a lot of smart people out there giving advice. A lot of hedge fund managers with fancy degrees and algorithms and high-frequency trading systems. So why does my opinion matter? Well, let me tell you this. I've been doing this for 74 years. I started buying stocks when I was 11 years old. Bought my first share in 1941, City Service Preferred. Paid $38. Watched it drop to 27. Scared me half to death. But I held on and eventually sold it at 40. Made a small profit and learned a big lesson. Markets go up and down, but if you own something real, something that produces value, you'll be okay in the long run. Since then, I've been through every kind of market you can imagine, you see. The post-war boom, the stagflation of the 70s, the crash of 87, the dot-com bubble, the housing crisis. And every single time, the same pattern repeats itself. People get greedy, prices get stupid, then reality hits, and the ones who survive are the ones who kept their heads. Now, my teacher was a man named Benjamin Graham, smartest guy I ever met, wrote a book called The Intelligent Investor back in 1949, and it changed my life. Graham taught me something simple but profound. He said the market is not a weighing machine in the short run. It's a voting machine. All these people voting with their emotions, their fears, their greed, but in the long run, it becomes a weighing machine. It weighs value, and value always wins. Graham had this concept he called Mr. Market, and I still use it today, you understand? He said, imagine the market as this manic depressive business partner who shows up at your door every day offering to buy your share of the business or sell you his. Some days he's euphoric, offering you crazy high prices. Other days he's depressed, willing to sell for nothing. The key is you don't have to trade with him just because he shows up. You only trade when the price makes sense. That's the whole game right there. Ignore Mr. Market's moods. Focus on the business. What does it do? How much cash does it generate? Does it have a durable competitive advantage? Can it raise prices without losing customers? Those are the questions that matter. And here's the thing. I'm not smarter than other people. I really am not. I just have more discipline. I can sit there and do nothing while everyone else is running around chasing the latest hot stock or the latest trend. My favorite holding period is forever. And that's not a joke. That's my actual strategy. When I bought Coca-Cola back in 1988, people thought I was crazy. And they said, Warren, it's not cheap. The PE ratio is high. But I didn't care about the PE ratio. I cared about the business. Coca-Cola had the strongest brand in the world. It sold a product people loved in every country on earth. It had pricing power. It generated cash. And it was going to keep doing that for the next 50 years. So I bought it, and I've never sold a share. That's value investing, you see, not buying cheap junk. Buying great businesses at fair prices and holding them while they compound. It's like planting an orchard. You don't dig up the trees every year to see how the roots are doing. You plant them, water them, and wait. Now, over time, my approach evolved a little bit. You know, early in my career, I was more of a pure Graham disciple. I'd buy mediocre businesses at cheap prices, what Graham called cigar butts. Companies trading below book value, below liquidation value, you get one last puff out of them and move on. That works when you're managing small amounts of capital. But when Berkshire got bigger, I couldn't do that anymore. There aren't enough cigar butts to move the needle when you're managing hundreds of billions of dollars. So I shifted, started focusing more on quality, started looking for businesses with what I call moats. economic moats, durable competitive advantages that protect them from competition, brand strength like Coca-Cola, network effects like American Express, low-cost advantages like Geico, switching costs like our railroad, BNSF. Those moats let you compound capital at high rates of return for decades. Charlie Munger, my partner for 60 years, rest his soul, he pushed me in that direction. Charlie always said it's better to buy a wonderful business at a fair price than a fair business at a wonderful price. And he was right. We made more money on our great businesses than we ever did on our cheap ones. But here's what hasn't changed, you understand. The temperament, the ability to be rational when everyone else is losing their minds. Ben Graham used to say, investing is not a matter of IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble. And that's the hardest part. Not the analysis, the emotional control. When the market's falling apart and your neighbors are panicking and the TV's screaming about the end of the world, can you sit there calmly and think about whether prices make sense? Can you buy when everyone else is selling? That's what separates the winners from the losers. I always say, be fearful when others are greedy and greedy when others are fearful. Sounds simple, but almost nobody does it because it's terrifying to go against the crowd. In 2008, when Lehman collapsed and the world felt like it was ending, I wrote an op-ed in the New York Times. I said I was buying American stocks. People thought I was insane. But that's when you make money, when blood's in the streets, even if some of it's your own. So that's the method, you see. Find great businesses, pay fair prices, hold them, ignore the noise, let compounding do the work. It's not complicated, but it takes decades of discipline to execute. And right now, my discipline is telling me to wait, because when I look at the fundamentals, when I look at the financial statements, when I look at the management quality and competitive positioning of most companies in the market, and then I look at the prices people are paying, it doesn't add up. So I'm sitting on cash, and I'm waiting for the pitch I want. Ted Williams, the baseball player, he once said, the secret to hitting is waiting for your pitch. You don't swing at everything. You wait for the ball in your zone, the one you can drive. Investing's the same way, except unlike baseball, there's no called strikes. You can stand there with a bat on your shoulder for years if you want, waiting for the perfect pitch. And that's what I'm doing right now. Because I've learned something in 74 years of doing this. You know, the market always gives you another chance. Always. You just have to be patient. And you have to have cash when that chance comes. Now, let me tell you something. When you look at the world the way an investor does, when you treat markets more like a cathedral than a casino, you start to see patterns that most folks miss, you see. What really worries me right now isn't just high prices or a bad quarter. It's these three big systemic risks that threaten the foundation, not just the drywall. First, government debt. This is the elephant in the room. The United States government debt is now reportedly somewhere between 122 and 125% of our gross domestic product. $37.6 trillion and counting. You understand? It took nearly 170 years to reach the first trillion. This year, the government spent more on interest payments than on national defense or Medicaid. The interest bill alone is eating up the federal budget, and every time the Treasury auctions more bonds, it's competing with private business for cash. That's inflationary, and it's a sign things are out of balance. Second, market concentration. Nearly all the market's gains this year have come from 10 companies, the so-called Magnificent 10 if you read the headlines. The S&P 500 looks diversified, but underneath, it's a pyramid with all the weight resting on a few stones. If one of those stones cracks, the whole structure is at risk. That's what happened in the dot-com bubble. That's what happened before the crash in 1929. When leadership narrows, stability weakens. Third, valuations. Stocks aren't priced for any kind of trouble. According to multiple sources, the broad market is trading near 28 times earnings levels we haven't seen since right after World War II, when the world was rebuilding and supply chains were broken. The risk is any slowdown, any hiccup in earnings, and there simply isn't a margin of safety. That's basic arithmetic. When you pay a high price, your future returns are low. So, you see, these aren't tomorrow's problems. They're already here. When you add up runaway debt, market concentration, and stretched valuations, you get a system that's less resilient than most people realize. And as someone who lives through cycles, I'll tell you this, it's the system risks, not the headlines or the politics, that ultimately catch people off guard. All right, so now you're probably wondering, well, Warren, if you're not buying stocks, what are you actually doing with all that money? And that's a fair question, because sitting on $381 billion isn't exactly what most people think of as a strategy. But let me explain something. Cash is a position. It's not doing nothing. It's waiting. And right now, that cash is earning us about 4 to 5% in short-term Treasury bills. Now, I know that doesn't sound exciting, 4%, but let me put it in context for you. You see, just a few years ago, those same Treasury bills were paying essentially zero. The Federal Reserve had rates pinned to the floor for over a decade. You got nothing for being safe, nothing for being liquid. Well, things have changed. Interest rates went up, and now, for the first time in years, we're getting paid to be patient. 4 or 5% risk-free return on $381 billion. That's over $15 billion a year in interest income. That's not nothing. That's real money. And here's the thing. The cash gives us optionality. When the market turns, and it will turn, we'll have the capital to buy. We'll be able to write checks that nobody else can write. That's what happened in 2008. That's what happened in 2020 when COVID hit and the market froze up for about 3 weeks. We had cash, we deployed it, and we made a lot of money because we were ready. Now, what have we been selling? Well, 2 big ones, Apple and Bank of America. Apple was our largest holding for years. Wonderful company. Tim Cook is a great manager. The brand is unbelievable. The ecosystem keeps customers locked in. I love everything about that business, but the stock got expensive. Really expensive. And when something gets too pricey, even if it's a great business, you have to be rational about it. So we started trimming. We didn't sell it all. You understand, we still own a big position. But we took some profits. We raised cash, and we redeployed that capital into Treasury bills earning a guaranteed return instead of hoping the stock keeps going up from already high levels. Bank of America, same story. Good bank, good management. But the stock ran up, and we took the opportunity to lighten up. When Mr. Market offers you a great price, you don't have to say no just because you like the business. You can take the money and wait for a better opportunity. And here's something else we've been doing, or rather not doing. We haven't been buying back our own stock. Now, Berkshire has a policy. We'll buy back shares if they're trading below intrinsic value. Makes sense, right? If your own stock is cheap, buy it. It's accretive to the remaining shareholders. But we haven't bought back a single share in 5 quarters. Why? Because even our own stock isn't cheap enough. Think about that. I know Berkshire better than anyone. I know every business we own, every manager, every competitive position, and even I don't think it's worth buying at current prices. That should tell you something about how I view the overall market. Now, I'm not saying Berkshire is overvalued. I'm just saying it's not undervalued. And I only buy back stock when it's clearly undervalued. Otherwise, I'm destroying value for long-term shareholders by paying too much. So what am I looking for? Well, I'm looking for businesses with a few characteristics. First, they need to have pricing power. Can they raise prices without losing customers? That's critical in an inflationary environment. If costs go up and you can't raise prices, your margins get squeezed and you're in trouble. Second, I want businesses that generate cash. Lots of free cash flow that we can reinvest or return to shareholders. Not earnings games, not accounting tricks, real cash. Third, I want durable competitive advantages, moats, something that protects the business from competition for decades, not just years. Brand strength, network effects, low-cost position, regulatory advantages, high switching costs, something structural. Fourth, I want good management, people who think like owners, not like hired hands, people who allocate capital intelligently and who are honest in their communications with shareholders. And fifth, I wanted at a fair price, not necessarily a bargain basement price, but a price where I can get a decent return over 10 or 20 years. Right now, I'm not finding many businesses that check all those boxes at prices I'm willing to pay. So I wait. And while I wait, I earn 4 or 5% in treasuries. And I keep my powder dry for when the opportunities present themselves. People ask me, Warren, what if you're wrong? What if the market keeps going up and you miss out? And my answer is always the same, you see. I'd rather miss out on gains than take losses I can't recover from. The first rule of investing is don't lose money. The second rule is don't forget the first rule. And right now, I think the risk of permanent loss is higher than the opportunity for gain. So that's what I'm doing. Selling when prices are high, holding cash, earning interest, waiting for better opportunities. It's not exciting, it's not sexy, but it's rational. And in the long run, rational wins. Now, here's where this gets personal for a lot of folks, you see. Because most people watching this, most people listening to me, they're not managing $380 billion. They've got $10,000, maybe less. And they're thinking, well, Warren, what does any of this have to do with me? You've got all the resources in the world. I'm just trying to build something for my family. And I understand that. I really do. But here's what I want you to know. The principles that work for me work for you too. The amounts are different, but the logic is the same. And in some ways, you actually have advantages I don't have anymore. Let me explain. When I was young, when I had small amounts of capital, I could buy tiny companies that nobody else was looking at. Cigar butt stocks trading below book value. Little businesses in boring industries that were cheap because Wall Street didn't care about them. I made a lot of money doing that. But now, with Berkshire size, I can't do it anymore. If I find a $50 million opportunity, it doesn't move the needle. I need billion-dollar opportunities. You don't have that problem. So if you've got less than $10,000, here's what I'd tell you to do. First, build liquidity. Cash is not trash, despite what you might hear on TV. Right now, you can earn 4 to 5% risk-free in a high-yield savings account or a money market fund or short-term treasury bills. That's real money. That's more than the stock market returned in a lot of years. So don't feel like you have to be fully invested all the time. Having cash gives you options. It lets you sleep at night, and it lets you buy when everyone else is panicking. I'd suggest keeping at least 3 to 6 months of living expenses in cash. That's your emergency fund. That's what protects you when you lose your job or your car breaks down or your kid needs braces. You don't want to be forced to sell your investments at the worst possible time just to pay bills. So build that cushion first. Second, if you're going to invest in stocks, keep it simple. For most people, the best thing to do is buy a low-cost S&P 500 index fund and hold it forever. I've said this for years, and I mean it. You don't need to pick individual stocks. You don't need to time the market. You don't need to follow the latest trends or listen to some guru on social media. Just buy the S&P 500. You're buying a piece of the 500 biggest companies in America. You're getting instant diversification. You're getting exposure to every sector of the economy. And you're letting the best businesses in the world work for you. Now, I've even put my money where my mouth is on this, you know. In my will, I've instructed the trustee for my wife to put 90% of her inheritance in a low-cost S&P 500 index fund and 10% in short-term government bonds. That's it. That's the 90-10 strategy. 90% stocks, 10% bonds. Simple, low cost, effective. If that's good enough for my family, it's good enough for yours. Third, dollar cost average. Don't try to time the market. You can't do it, I can't do it, nobody can do it consistently. So instead, invest a fixed amount every month, no matter what the market's doing. When prices are high, you'll buy fewer shares. When prices are low, you'll buy more shares. Over time, this smooths out your cost basis and takes the emotion out of the decision. Fourth, reinvest your dividends. This is how compounding works, you see. When your stocks pay dividends, don't spend the cash. Use it to buy more shares. Those new shares will generate their own dividends, which you reinvest again. Over decades, this turns into serious wealth. Fifth, avoid speculation. Don't day trade. Don't buy meme stocks. Don't chase hot tips or penny stocks or cryptocurrencies or whatever the latest fad is. Those are not investments. They're gambles. An investment produces something. A stock represents a business that makes products, serves customers, generates cash. A farm produces crops. A rental property produces rent. Those are productive assets. Cryptocurrencies don't produce anything. Gold doesn't produce anything. Their value is entirely based on what someone else will pay you for them tomorrow. That's speculation, not investing. And I've seen too many people lose everything chasing those kinds of bets. Sixth, focus on what you can control. You can't control the market. You can't control interest rates or inflation or recessions, but you can control your savings rate. You can control your expenses. You can control how much debt you carry. Those things matter more than your investment returns, especially when you're starting out. If you save 10% of your income versus 5%, you've doubled your wealth building capacity. That's more powerful than trying to pick the perfect stock. So live below your means, avoid consumer debt, increase your income if you can, and invest the difference. Seventh, be patient. This is maybe the hardest part, you understand. We live in a world of instant gratification. Everyone wants to get rich quick, but wealth is built slowly over decades through consistent saving and compounding. My favorite holding period is forever, and that should be yours too. When you buy that S&P 500 index fund, you're not trading it next week or next month or even next year. You're holding it for 20, 30, 40 years. You're letting those businesses grow. You're letting your dividends reinvest. You're letting time do the heavy lifting. And here's the beautiful part. If you start young, even small amounts turn into big numbers. Let's say you're 25 years old and you invest $200 a month in an S&P 500 index fund. If you earn the historical average return of about 10% a year, by the time you're 65, you'll have over $1.1 million. That's from just $200 a month. That's the power of compounding. But you have to stick with it. You can't panic and sell when the market drops 20 or 30%, which it will. You can't get greedy and chase hot stocks when everything's going up. You have to be disciplined. You have to be rational. You have to tune out the noise. And look, I know this isn't exciting advice, you see. It's not going to make you rich overnight, but it works. It's what I recommend to my own family. And it's what's made millions of ordinary people wealthy over the decades. The stock market is not a casino. It's a mechanism for owning the best businesses in the world. And over the long run, those businesses grow, innovate, serve customers, and generate profits. If you own a piece of them, you share in that success. It's that simple. So if you have less than $10,000, don't despair. You're not too late. You're not too small. You just need a plan, some discipline, and the patience to let it work. And if you do that, I promise you, you'll be just fine. Now, here's something most people don't want to hear, but it's the truth. Your biggest enemy as an investor isn't the market. It's not inflation. It's not the Federal Reserve or recessions or bear markets. It's you. It's your own emotions, your fear, your greed, your need to do something even when doing nothing is the right move. Ben Graham, my teacher, he said something I'll never forget. He said, investing doesn't require genius. It requires temperament. Once you have ordinary intelligence, what you need is the ability to control the urges that get other people into trouble. And let me tell you something. You see, I've watched brilliant people, really smart folks with Ivy League degrees and high IQs, lose everything in the stock market. And I've watched ordinary people with no special training build real wealth over decades. The difference wasn't intelligence. It was discipline. The first rule of investing is don't lose money. The second rule is never forget the first rule. Sounds simple, right? But most people violate those rules constantly because they can't control their emotions. When the market's going up, people get greedy. They see their neighbors making money. They see stocks doubling and tripling, and they think, I'm missing out. I need to get in. So they buy at high prices, chasing performance, buying things they don't understand just because the price is going up. Then the market turns, prices fall, and those same people panic. They see their account balances dropping. They can't sleep at night. They watch CNBC and every headline is doom and gloom. So they sell, locking in their losses right at the bottom. Buy high, sell low. That's what emotions make you do. And it's the exact opposite of what you should be doing. I've said for years, be fearful when others are greedy and greedy when others are fearful. But almost nobody can do it because it requires you to go against the crowd. And humans are wired to follow the herd. We're social animals. We want to fit in. We want to do what everyone else is doing. But the herd is almost always wrong at extremes. When everyone's euphoric, that's when you should be cautious. When everyone's panicking, that's when you should be looking for opportunities. In March of 2009, right after the financial crisis, stocks were at generational lows. You could buy great businesses for pennies on the dollar, but nobody wanted to. People were terrified. They thought the world was ending. They thought the banking system would collapse and we'd have another Great Depression. I wrote an op-ed in the New York Times saying I was buying American stocks, and people thought I was crazy. But you know what? That was one of the best buying opportunities in history. If you'd bought the S&P 500 in March of 2009 and held it, you'd have made over 500% by now. But it took courage. It took the ability to think independently when everyone around you was losing their minds. Now, how do you develop that kind of discipline you understand? Well, it starts with understanding what you own. I only buy something that I'd be perfectly happy to hold if the market shut down for 10 years. That's my test. If the stock market closed tomorrow and I couldn't see a price quote for a decade, would I still want to own this business? If the answer is yes, then I'm buying it for the right reasons. I'm buying it because the business generates cash, serves customers, has a durable competitive advantage. I'm not buying it because I think someone will pay me more for it next week. But if the answer is no, if I'm just hoping the price goes up, then I'm speculating. And speculation is driven by emotion, not reason. Second thing is you have to tune out the noise. I don't pay attention to day-to-day stock price movements. I don't care what the market does tomorrow or next week or next month. I care about what the businesses I own will be worth in 5 or 10 or 20 years. All that daily volatility, those squiggly lines on a chart, that's just Mr. Market being manic depressive. Some days he's happy, some days he's sad. But the underlying value of the business doesn't change just because the stock price bounces around. Most people can't ignore that noise. They check their portfolios every day, sometimes multiple times a day. And every time the market drops, they feel pain. Every time it goes up, they feel euphoria. That's exhausting. And it leads to bad decisions. I look at my businesses maybe once a quarter when the earnings come out. Otherwise, I'm reading, I'm thinking, I'm learning about new industries and companies, but I'm not obsessing over price quotes. Third, you need to understand risk properly. Most people think risk is volatility. They think a stock that bounces around a lot is risky. But that's not how I see it. Risk comes from not knowing what you're doing. If you don't understand a business, if you can't explain how it makes money, if you don't know what could go wrong, then it's risky no matter how stable the stock price is. But if you understand the business, if you know its competitive position, its financials, its management, then volatility isn't risk, it's opportunity. When a great business drops in price because Mr. Market is having a bad day, that's not risky, that's a gift. Fourth, and this is critical, you have to separate price from value. Price is what you pay, value is what you get. They're not the same thing. A stock can be expensive at a low price if the business is lousy, and a stock can be cheap at a high price if the business is great. You have to focus on value, not price. Most people do the opposite. They see a stock that's gone down and they think it's cheap, or they see a stock that's gone up and they think it's expensive. But that's backwards. You have to look at what the business is worth, not what the stock has done lately. Fifth, you need patience. Real grinding, sometimes painful patience. My favorite holding period is forever. I'm not joking when I say that. When I buy a business, I plan to own it for decades. That means sitting through market crashes, sitting through recessions, sitting through periods where the stock does nothing for years. It means ignoring the people who tell you you're wrong or you're missing out on the next hot thing. But that's how wealth compounds. Not through trading, not through timing, but through patient, long-term ownership of great businesses. And Look, I get it. This is hard. It's really hard. When you see Bitcoin going up 50% and your index fund is up 8%, it's tempting to chase that performance. When the market crashes and you're down 20%, it's terrifying to hold on. But investing is supposed to be boring. It's supposed to be uneventful. If you're getting an adrenaline rush from your portfolio, you're doing it wrong. The people who make real money, the people who build lasting wealth, they're the ones who can sit there calmly, ignoring the panic around them, focused on business fundamentals, thinking in decades, not days. And here's the beautiful part, you see. Once you develop that discipline, once you learn to control your emotions, you have an edge over almost everyone else in the market, because most people can't do it. Most people will always be driven by fear and greed. So if you can master yourself, if you can be rational when others are irrational, you'll do just fine, better than fine. You'll compound wealth for decades while everyone else is chasing their tails. That's the real secret, you understand? Not some complicated strategy or insider knowledge, just discipline, just temperament, just the ability to think clearly when everyone else is losing their minds. And if you can do that, if you can really do that, then the amount of money you start with doesn't matter nearly as much as you think, because you'll make good decisions, you'll avoid big mistakes, and over time, that's what wins. All right, now we need to talk about the hard part, you see, the part most politicians don't want to discuss and most economists dance around. We need to talk about what happens when a government has $37.6 trillion in debt and no realistic way to pay it back. Because here's the thing you understand, there are only three ways to deal with debt this large. You can grow your way out of it, you can cut spending and pay it down, or you can inflate it away, and two of those options are politically impossible. Let me explain. Growing your way out means your economy expands faster than your debt, your tax revenues go up, your debt to GDP ratio goes down, and eventually you stabilize. That's what happened after World War II. We had huge debts from the war effort, but the economy grew like crazy for 3 decades. Manufacturing boomed, the middle class expanded, and the debt became manageable, but that's not happening now. Our debt is growing faster than our economy. We're running trillion-dollar deficits every single year, even when unemployment is low and the economy is supposedly doing well. In fiscal year 2025, the debt increased by $2.2 trillion. That's in 1 year. And the interest on that debt, well, it's become the fastest growing part of the federal budget. We're now spending more on interest than we spend on defense, more than we spend on Medicaid. And as interest rates went up over the past few years, that burden got heavier. So we can't grow our way out. The math doesn't work. The second option is to cut spending and pay down the debt. Sounds responsible, right? But here's the problem. Most of the federal budget is mandatory spending. Social Security, Medicare, Medicaid, interest on the debt. You can't just cut those without massive political backlash. And the discretionary spending, defense, education, infrastructure, that's only about 30% of the budget. So even if you cut every single discretionary program to zero, which you can't do, you still wouldn't balance the budget. You'd need to cut entitlements. And no politician wants to touch that with a 10-foot pole. Try telling 70 million retirees that their Social Security checks are getting cut. Good luck getting reelected. So we're not going to cut our way out either. That leaves option 3. Inflation, and this is where it gets scary, you see, because inflation is the path of least resistance. It's the politically easy way to deal with debt. Here's how it works. The government borrows money by selling treasury bonds. Those bonds pay a fixed rate of interest. If you lend the government $1,000 at 3% interest, you get $30 a year, and in 10 years you get your $1,000 back. But if inflation runs at 5% a year during that time, your $1,000 isn't worth $1,000 anymore. It's worth about $600 in purchasing power. You got paid back, but you got paid back in cheaper dollars. The government just inflated away 40% of the real value of what they owed you. And that's the game, you understand. Print money, create inflation, and watch the real burden of your debt shrink. It's a stealth default. You're not technically refusing to pay. You're just paying in money that's worth less. Now, I've been talking about this for years. I told Congress back in early 2025, that the deficit is a critical concern. I said the government has no choice but to keep printing money because they can't cut spending and they can't raise taxes enough to make a difference without tanking the economy. So what does that mean for you? Well, it means your purchasing power is going to erode. The money in your bank account, your savings account earning 4%, it's losing value in real terms if inflation is running at 5 or 6%. That loaf of bread that costs $3 today might cost $5 in 5 years. That gallon of gas, that pound of coffee, that rent payment, it all goes up. And if your income doesn't keep pace, you're getting poorer even though the dollar number in your bank account might be going up. This is why I own businesses, not bonds. Businesses can raise prices. They have pricing power. If Coca-Cola's costs go up because of inflation, they raise the price of a Coke. If our railroad, BNSF, faces higher fuel costs, they raise shipping rates. Our insurance company, Geico, raises premiums. Good businesses pass inflation on to customers. They protect you from currency debasement. Bonds don't. Cash doesn't. If you're sitting in treasury bills earning 4% and inflation is running at 6%, you're losing 2% a year in real terms. Now, the government will tell you inflation is under control. They'll point to the CPI, the Consumer Price Index, and say it's only 3% or whatever the number is. But you and I both know that's not the full story because the CPI doesn't capture everything. It doesn't fully capture housing costs, healthcare costs, education costs, all the things that actually matter to ordinary people. Your health insurance premiums have probably gone up way more than 3%. Your property taxes, your homeowner's insurance, your car insurance, all of it's going up faster than the official inflation rate. So the real inflation, the inflation you experience in your daily life, is probably higher than what the government reports. And that's by design, you see, because if they reported the real number, they'd have to pay more in Social Security cost of living adjustments and other index programs. So they use methodologies that understate it. And here's the really concerning part. We're at a point now where the debt is so large that even if we wanted to stop inflating, we probably can't. Because if the Federal Reserve raises interest rates too high to fight inflation, the interest cost on the debt becomes unbearable. The government literally can't afford it. So they're stuck, you understand. They can't let rates get too high or the debt spiral gets worse. But they can't keep rates too low or inflation runs out of control. It's a trap. And the way out of that trap is slow, steady, managed inflation that erodes the debt over time while trying not to cause too much economic pain. That's the plan, whether they admit it or not. Inflate away the debt slowly over years and decades. And if you're sitting in cash or bonds, you're the one paying for it. Now, I'm not trying to be alarmist here. This isn't going to happen overnight. This is a slow motion train wreck, not a sudden crash. But it's real and it's already happening. So what do you do about it? Well, you own productive assets. You own businesses that can adapt to inflation. You own real estate that increases in value. You own commodities if you understand them. You own things that produce income and grow over time. What you don't do is sit in cash for decades. You don't buy long-term bonds at low rates. You don't assume that the purchasing power of $1 today will be the same in 20 years, because it won't be. And you educate yourself. You pay attention. You understand that the financial system is being slowly reshaped by these massive debt burdens and the political inability to deal with them honestly. This is why I'm sitting on so much cash right now. Not because cash is a great long-term investment. It's not. But because I'm waiting for the moment when assets get repriced, when reality sets in, when the market realizes that valuations don't make sense in a world of persistent inflation and slowing growth. And when that moment comes, I'll deploy that cash into businesses that can thrive in that environment. Businesses with pricing power, low capital needs, strong brands, and the ability to compound at high rates of return, even in a tougher economic climate. That's the warning, you see. The debt is unsustainable. The political will to fix it doesn't exist. Inflation is the only way out. And if you're not prepared for that, if you're not positioned correctly, you're going to watch your wealth slowly erode while wondering what happened. So take this seriously, you understand, because the next 10 or 20 years are not going to look like the last 10 or 20 years. The rules are changing. The game is different. And the people who understand that early are the ones who will come out ahead. All right, well, we've covered a lot of ground here. You see, we talked about systemic risks, government debt, market valuations, emotional discipline, inflation, all of it. And maybe right now you're sitting there thinking, Warren, this is all very interesting, but what am I supposed to do about it? I've got to go to work Monday morning. I've got bills to pay. I've got a family to take care of. Give me something practical. Fair enough. So let me bring this back down to earth and tell you exactly what to do. First thing Monday morning, or whenever you get a chance, sit down and take an honest look at your financial situation. Write it down. How much do you make? How much do you spend? How much debt do you have? How much are you saving? What's in your retirement account? What's sitting in cash? You can't make good decisions without knowing where you stand. Most people never do this. They just kind of float through hoping it works out. That's not a plan. That's a prayer. Second, if you don't have an emergency fund, build one. 3 to 6 months of living expenses in a high-yield savings account or money market fund earning 4 to 5%. This is not your investment money. This is your sleep-at-night money. This is what keeps you from panicking and making bad decisions when life throws you a curveball. Third, if you have high-interest debt, credit cards, personal loans, pay it off. I don't care what the stock market's doing. If you're paying 18% interest on a credit card balance, that's an emergency. You can't build wealth while you're being drained by interest payments. Pay that off first. Fourth, once you've got your emergency fund and you've paid off high interest debt, start investing and keep it simple. For most people, that means putting money into a low-cost S&P 500 index fund every single month. Automate it if you can. Set it up so the money comes out of your paycheck or your bank account before you even see it. Pay yourself first. Don't try to time the market. Don't wait for a crash. Don't wait for things to feel safe, because by the time it feels safe, prices will already be high again. Just invest consistently, month after month, year after year. Fifth, ignore the noise. Turn off CNBC. Stop checking your portfolio every day. Unfollow the people on social media who are constantly predicting crashes or telling you to buy the latest hot stock. All that noise is just going to make you emotional and lead you to bad decisions. Sixth, educate yourself. Read books. Learn about investing, about businesses, about economic history. I recommend starting with The Intelligent Investor by Benjamin Graham. That book changed my life. It'll give you the foundation you need to think clearly about investing. Seventh, be patient. Understand that building wealth takes decades, not days. You're not going to get rich quick. You're going to get rich slowly through consistent saving, smart investing, and letting compound interest do the heavy lifting. And look, I know what some of you are thinking. You're thinking, Warren, you just spent the last hour telling me the market's overvalued, the debt's out of control, inflation's coming, everything's a mess. And now you're telling me to invest in an index fund? How does that make sense? Well, let me explain, you see. Yes, I think the market's expensive right now. Yes, I think we're going to see volatility. Yes, I think there's a significant correction coming at some point in the next few years. I've said publicly that we're going to see a period in the next 20 years that will be a hair curler compared to anything we've seen before. But here's the thing. I don't know when. It could be next month. It could be next year. It could be 5 years from now. Nobody knows. And if you sit in cash waiting for the perfect moment, you might wait forever. The Buffett indicator, my favorite market valuation metric, is at the highest level it's ever been. The stock market would have to fall 40% just to get back to fair value based on historical averages. And we're sitting more than 2 standard deviations above the normal trend line. That tells me valuations are stretched, +1. But it doesn't tell me when the correction happens. The market can stay expensive for years. And if you're a long-term investor, if you're investing for 20 or 30 or 40 years, then what happens in the next year or two doesn't matter that much. What matters is that you're participating in the growth of American business over decades. And despite all the problems, despite the debt and the dysfunction and the risks, I still believe American business will be worth more in 20 years than it is today. Now, if you're older, if you're close to retirement, then yes, you should be more conservative. You should have more in bonds, more in cash. You don't have time to ride out a big decline. But if you're young, if you've got decades ahead of you, then you should be invested. Because here's the secret, you understand. The people who make real money in the stock market are the ones who stay invested through the crashes. They're the ones who keep buying when prices are falling and everyone else is panicking. They're the ones who understand that volatility is the price you pay for long-term returns. Since 1950, the S&P 500 has had a decline of 20% or more, 9 times. That's one every 8 years on average. And every single time, people thought it was the end of the world. And every single time, the market eventually recovered and went on to new highs. So crashes are normal. They're part of the deal. If you can't handle that, if you're going to panic and sell every time the market drops, then you shouldn't be in stocks. But if you can stay calm, if you can keep your head while everyone else is losing theirs, then you'll do just fine. So that's the plan, you see. Build your emergency fund, pay off bad debt, invest consistently in low-cost index funds, ignore the noise, be patient, stay disciplined, and understand that the journey is going to be bumpy, but the destination makes it worthwhile. I've been doing this for 74 years. I've seen every kind of market, every kind of crisis, every kind of panic. And the one constant, the thing that never changes, is that good businesses create value over time. And if you own a piece of those businesses and you hold on through the ups and downs, you'll build wealth. It's not complicated, it's not sexy, but it works. So go do it. Start today. Start Monday morning. Open that savings account. Set up that automatic investment. Turn off the TV, pick up a book, make a plan, and stick to it. And remember, you see, investing is not about getting rich quick. It's about getting rich slowly and surely through discipline, patience, and rational thinking. That's all I've got for you. That's the warning. That's the plan. Now it's up to you to execute. Thanks for listening.